Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two beaten down stocks to consider buying ahead of earnings for some long-term upside. And those two stocks we're looking at today are Taiwan Semiconductor and Union Pacific. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these two stocks to consider looking at, I just wanted to do a broader market overview since this helps provide context for why we're possibly looking at these two stocks. So as of Friday morning, mid-morning, when I'm recording this, the S&P 500 was down about 0.5% and the NASDAQ was down about 0.7%. This came as the first quarter earnings season unofficially kicks off with JP Morgan and Citi and some other big banks. So we had those results come in. JP Morgan posted record revenue in the first quarter with its shares up about 7% the last time I looked. Meanwhile, Citi Group said the bank's profits were boosted by higher interest rates. So those shares were up 3% the last time I looked. So that's the big news on Friday morning. And then the big news Thursday was wholesale prices. So the producer price index fell in March by the most in roughly 3 years, which is right at the onset of the pandemic. So that's another good sign that inflation is cooling. This came after the big CPI data on Wednesday. So that was CPI coming in at 5% in March versus 5.1% forecast and under February 6%. Obviously, we're well below those peaks from the summer of about 9%, but we're still way above the Fed's 2% floating target. And it's worth noting that that could be a little bit harder to keep grinding down lower, as shelter costs have been a big factor in why inflation is still so high. And that's kind of hard to get rid of. With this in mind, the Fed is now being projected to cut or raise interest rates by 25 basis points at its next meeting. So traders had essentially been split about 70-30 in favor of a 25 basis point hike that would take the Fed funds rate up to between 5% and 5.25%. And that's expected to be the last hike of the year. The last time I looked then on Friday morning, that had shifted to about 82 versus 18. So even more conviction that the Fed's going to raise one more time in May at least. And then Wall Street's betting that by the end of the year, so by December, they're going to have started to reverse course and start to lower rates. Obviously, the market's really focused on this because interest rates and earnings are the two things that really drive stocks over the long haul. So if we do see inflation keep coming down and the Fed possibly being able to at least maintain rates or take its foot off the gas, the market could drive higher. If not, we could see some selling come up. So the April inflation reading and then anything after that will have to continue to show cooling down. With that said, despite this dip on Friday, this came after a big jump on Thursday. So both the NASDAQ and the S&P 500 are well above both their 50-day and 200-day, and they haven't even come close really to testing those 50-day levels yet. So still pretty bullish. And then obviously the earnings season is going to be a big factor in determining what happens next, because lots of people are expecting the earnings guidance to come in a lot lower than expected. So if we do see earnings have to come and be revised lower for, say, the back half of 2023, we could see the market also face some selling, as we'll have to recalibrate stocks to accommodate that. If earnings do hold up relatively well for the S&P 500 in the coming weeks, then we could easily maintain that momentum. So that's the backdrop as we head into, as I said, the busy part of Q1 earnings season. And the two stocks we're going to look at today report their earnings next week. And the first stock we're looking at of these two beaten down stocks to consider buying for long-term growth is Taiwan Semiconductor Manufacturing Company. That's the full name. Its ticker is TSM. Sometimes you hear people refer to it as TSMC, which is that Taiwan Semiconductor Manufacturing Company. So they report on Thursday, April 20th, their first quarter 2023 earnings. So we're just going to jump into the case for Taiwan Semi. So Taiwan Semi is not as maybe flashy as some of the other chip stocks you hear about, like the NVIDIAs and those, but it plays one of the most pivotal roles in the entire industry because it actually builds the physical semiconductors TSM is the world's largest chip manufacturer. It reportedly claims roughly 55% of the global foundry market, to more than double its next largest peer. Chip companies of all shapes and sizes turn to foundries like Taiwan Semi for their integrated chip production because the cost and time involved are enormous to do on your own. The company stands to benefit really from the never-ending tech revolution. There's no doubt that semiconductors are going to remain the backbone of the digital world, and then obviously arguably the entire economy when you think about it that way. The company has expanded its revenue pretty significantly over the long haul, and then TSM's revenue surged by roughly 20% in 2022 after it climbed 20% in 2021 and 33% back in 2020. Amid that boom, the company is projected to post roughly 3% revenue growth in 2023 and then 15% lower adjusted earnings growth in the historically cyclical chip space. So thankfully, though, it is projected to bounce back in a big way in 2024 and post 17% higher earnings and 14% stronger revenue. So looking ahead to 2024, as I said, the chip space is very cyclical, but long term, it's trending upwards at all times. The company is also able to, it was the first foundry to produce 5 nanometer chips, and it's committed to manufacturing smaller than ever chips. The company, which currently grabs the number 3 hold at the moment, is rolling out new facilities that can manufacture cutting edge 3 nanometer transistors. The company's also investing in factories in the U.S., which is being spurred by U.S. government incentives as it tries to expand outside of Taiwan. Obviously, some people are concerned about the tensions between the U.S. and China, and then obviously the tensions between China and Taiwan. So some people don't like to even consider TSM. We noted, if you probably see headlines, if you look up Taiwan Semi, that Warren Buffett and Berkshire sold their position in Taiwan Semi, even though it was a big deal that they bought it. And he did say that the headlines are saying that the U.S., China, Taiwan tensions are part of the reason why he sold a large chunk of that position. Either way, if you can stomach the possibility of anything happening, but in the end, it seems like Taiwan Semi is probably too important to both countries to really mess with anything. So that's just a thing you have to worry about in the background. But overall, the stock is been up 105% in the last 5 years, despite all these worries, versus the tech sector's 65% climb. The chip-making powerhouse has easily outpaced tech also over the last 10 years, up around 365% versus 215%. That said, it's still down around 40% from its peaks, even though it has surged about 35% since early November. Its valuation is also pretty solid as well, so it's trading at a 55% discount to its own highs, at about 14.9 times forward 12-month earnings. Its forward priced earnings also matches its own decade median and offers about 30% value compared to the Zacks tech sector. Alongside its valuation and upside, Taiwan Semi's dividend yields about 1.6% at the moment, and it boasts a really strong balance sheet. It sits below neutral RSI levels at 40, so that's like the real basic pitch. I will say that I do own Taiwan Semi personally, so just putting that out there as just a note. So some investors, though, might want to consider diving in ahead of earnings, while others might want to wait it out. Some people are very into trying to play directly around earnings, but longer term investors don't really need to try to time things precisely. Maybe Taiwan Semi is able to provide great guidance and it shoots right after earnings. And if you missed out, you could be a little upset, but you could still buy it in. And maybe they provide a little bit worse guidance or something and they slip and you can buy it at a little lower price. So that's kind of the idea of maybe waiting or getting in. But if you're, as I said, a longer term investor who's high on the stock, it's maybe worth getting in at these levels, especially as so many other tech stocks have ripped higher and gotten a little bit bloated in terms of valuation. So the next stock we're going to look at out of these two is Union Pacific, which is trading under the ticker UNP. They also report their first quarter 2023 results on Thursday, April 20th. And just like with Taiwan Semi, we're just going to go through the broader company and maybe why you should consider it heading into the first quarter earnings season as a longer term play. So Union Pacific is a rail, freight, giant and one of the most kind of logical long-term plays in the wider world of transportation infrastructure, as are a lot of these big railroad stocks as part of a diversified portfolio. So the company links together over 20 states in the western two-thirds of the U.S. It's helping serve some of the fastest growing cities in the country. UNP connects also with Canada's rail system as well, and it's the only rail serving all 6 major Mexico gateways. So overall, has a huge swath of the country and parts of really North America in general that it covers. Union Pacific started to run also far fewer trains with far more cars long before the pandemic. That's part of a process known as precision scheduled railroading. UNP already operates some of the longest runs in the U.S., and management is pretty confident that it can one day produce some of the lowest ratios of expenses to revenue in the industry. That said, the company is dealing with some issues, and the stock has been hit because of it, so it's facing near-term headwinds. So Union Pacific, along with the wider U.S. railroad operators, have pretty subdued outlooks for 2023 as they brace for a slowdown in demand for manufactured goods and other products and higher costs as well. Inflation's hurting manufacturers and the housing market, which are some of the biggest customers for the broader rail industry. But as I said, with Taiwan Semi, the economy is cyclical, but if you're a long-term investor, these two stocks should be able to go up over the long haul, as we'll see in a bit. So on top of that, Union Pacific announced relatively recently, like a few months ago, that its CEO would be stepping down amid an activist push to kind of shake things up and encourage Union Pacific to boost profits even more and improve its operations amid, as I said, this slowdown from the industry. So overall, over the last 10 years, the company's kind of ebbed and flowed with the economy. So you have 9% growth in 2014, and then a 9% decline, and then an 8% decline, but then 7% growth and 8% growth. So you get the story. It's been back and forth. So the last 2 years, it did 12% growth and then 14% growth. And then it did 14% earnings growth last year as well. So with this in mind, it's expected to see its sales essentially come in flat in 2023 and then climb again in 2024, with earnings expected to jump 7% in 2024 as well, after climbing roughly 1% this year. So against a difficult to compete against 2-year stretch, the company is still expected to essentially come in flat for sales and post 1% higher earnings. So nothing too bad despite the headwinds at the moment. And overall, the Zacks earnings estimates have remained relatively stable over the last few months. So that's a pretty good sign. The stock currently grabs Zacks rank number 3 hold, and it's worth noting that the transportation and rail industry is in the top 23% of over 240 Zacks industries. Union Pacific has also paid a dividend for 124 years in a row. So that's a stable business if there is any. And it's raised its payout by 15% annualized over the last 5 years. It's currently yielding about 2.6% at the moment. The company also bought back a large chunk of stock last year. And it's committed, as I mentioned, to efficiency and modernization going forward to help reduce costs over the long haul and boost profits. And it's also worth noting that they're focusing on how to kind of get along with the wider renewable energy and green movement push. And it is worth noting that railroads could become maybe even more critical, as they're far more fuel efficient than lots of other transportation, and it's one of the only ways where you can get these massive things around the United States, which is never going to go out of style. So now let's kind of close out by looking at some price and valuation metrics for Union Pacific. So the stock's up 45% over the last 5 years versus the Zacks transportation sector's just 6% climb. So that gives a nice context. And if we look back over the last 25 years, Union Pacific stock is up 1,300% versus the S&P 500's just 350% climb. So it shows just how long-term the upward trajectory the stock has had compared to the wider market. And then the stock is up about 35% in the last 3 years, even though it is down 30% from its peak. So this is another reason why maybe investors want to consider buying it. And it's sitting now 12% below its average Zacks price target. And then in terms of brokerage recommendations, of the 24 brokerage recommendations that we have, 11 are coming in at strong buys, with 11 coming in at holds and nothing below hold. So that's a good sign that despite some of the current headwinds, no one's saying you should be selling Union Pacific stock. That said, if you're a technical trader, the stock has been rejected a few times recently, right at its 50-day moving average. So hopefully if it breaks above that, it can start rebounding even more and then finally break above its 200-day. And then we can take a look at its valuation kind of as we wrap up here. So Union Pacific is trading at 16.9 times forward 12-month earnings, which marks 30% value compared to its decade long highs. And it's trading also below its decade-long median as well. So that's a good sign for the stock. And then it's also trading at a discount to the wider S&P 500. And then kind of overall, to wrap things up here, for both Taiwan Semi and Union Pacific, it's worth to consider, especially for these long-term buy and hold stocks, especially for companies that have proven themselves in key industries like Taiwan Semi and Union Pacific for a really long time now, that it's kind of best time to buy these stocks when other people are a little nervous or a little hesitant and don't want to buy, and then possibly sell some shares or sell your position when everyone does. So that's kind of the mantra at the moment, and it's worth considering these two stocks heading into the busy part of first quarter earnings season next week. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.